Oh man, the Fed's gonna want to wreck us now. Two videos to react to here today and in this one, folks. First one up here is recent equity rally only compels the Fed to step up hawkish rhetoric. This one's from about 4 hours ago. I want to react to that one. I think it's important. And then this one from 5 hours ago, Mohamed El-Erian, inflation has moved from goods to services sector. I want to hear what he's talking about there and kind of give a few points that I think I have in regards to that. Now, today, I was just looking. The public count alone today is up over $48,000. Just today, okay? Just in the past few hours. Now, that's a problem for the Fed, a big problem. So let's say, hypothetically, I'm up $100,000 today, right? Between all my different portfolios. That's not good for the Fed. The Fed does not want to see that. The Fed usually encourages that and loves that in almost any other time. But with inflation still being very high right now, they don't want to see that. Because the bottom line is, the more money I make off stocks, the more likely I am to go buy new stuff with it, or go on a vacation, or go buy new rental properties, or whatever, right? And add to the whole inflationary problem. And so during a time period when you still have very high inflation, the Fed's trying to work against the market. They don't want to see us make money right now. And that's a fact. That's not an opinion. That's a fact as of right now. They don't want to see this. And so we're in a very interesting dynamic now where the market's starting to rally big. A lot of us are starting to make a lot of money, and the Fed doesn't want that yet. A year from now, they're okay with that. 2 years from now, they're okay, but not right now. They really don't want to see that. So nonetheless, hope you guys enjoyed today's video. As always, I appreciate everybody joining me. By the way, I got a baby back there, okay? I'm on baby duty right now. So if he makes some noise, I'm sorry. Sometimes people get mad at me and they're like, why don't you have a studio? And these sorts of things. And here's the deal. I don't like to just work in like a little office or something like that. I love to just work where I want to work, which is around the family, which is in the house, in the living room, on the couch, sitting in the chairs. Sometimes I work outside. That's just me. I'm not like, oh, let me put myself in a little room and like, let me work in there. I've worked pretty darn hard for the past 15 years to get to this place where I can work wherever I want. And like, if you have a problem with that, that's fine. I understand, but I'm not going to really change me. I'm just going to do what I do. So hope you guys enjoyed today's video. Also, thank you everybody that supports the channel on Patreon. If you haven't joined us over there, what the heck are you doing? We're now over 250 members on Patreon. We got one of the fastest growing Patreons in the world right now. And that portfolio is tearing it up. I buy consistently every single week in that portfolio. Just bought new stocks in there. Check that out. Also, if you're looking to apply for my private stock group, the private wealth group, that will be linked in the description area. Let's get into this.
Investments at Citi Global Wealth. We got the Dow looking like it will move higher this morning, in large part on the back of this activist news around Salesforce, Chris. And after us all just getting back from Davos, I think there's a real question as to what happens next. There was a sort of I don't want to say a sense of optimism. I don't know what it was grounded in, but maybe it's being reflected actually in what we think the Fed may or may not do. Where do you stand?
By the way, before we get to the Fed, Salesforce, it's a buy. It's not a stock I personally own because there's so many stocks that are buys out there. But Salesforce, like if you've been buying that stock over the past 1 to 2 months, in my opinion, you're going to likely do very well for yourself over the next few years.
Look, I would love to be an optimist, and I am an optimist in many ways, but unfortunately, the market action that we've seen year to date, if anything, I think that this recent rally is only going to compel the Fed to step up their hawkish rhetoric. And this whole discussion that we have around now it's a 25 basis point hike in February. This is on the back of 450 basis points of hikes last year, in addition to $450 billion coming out, liquidity taken out of the bond market.
Great point. Look at the stocks. I mean, just look at them roaring today. I mean, Avant 10%, Revolve another 8%. I think Revolve was up 8% on Friday. Another 8%. I mean, look at the moves. It's just, I mean, it's incredible, right? Incredible. It reminds us of the good old days, right? I mean, just absolutely nuts.
Cumulative medicine that the Fed is injecting into markets and the economy has not been seen in earnings yet. And this is why we're still playing defense and we're cautious here.
So you think there's a head fake? Would you, I mean, look, if you've been waiting, is it you're going to sell some stuff in this market right now because you think it's going lower?
So the way that we've been positioned coming into this year is actually we've been overweight fixed income relative to equities. And even within our fixed income portfolios, we've been overweight on the quality side. So that includes investment grade, that includes government, that includes municipals for taxable investors, as well as preferreds, which were offering attractive yields. For us really to then take on significant positions on the equity side, this is going to require either a big change in the employment backdrop or a big change in inflation, neither one which we anticipate would happen over the next couple of months. So we have equities in our portfolios, but still we're talking about dividend growers. We're talking about the resilient sectors that have been able to outperform in recessions like healthcare and global pharma.
Clearly, you're playing the role of contrarian of sorts this morning. Mohamed El-Erian said he wanted the Fed to go to 50 basis points, but he wanted them to go to 50 basis points. Doesn't think that they will. It sounds like you may think that they will.
No, so we actually think the base case is 25 basis points. The Fed tends to do what's in line with markets. In terms of, I think the big question, and Mohamed alluded to this as well and pointed this out, the Fed's target of 2%, we're still really far away from that. So this idea that we're going to see a material progress down to that 2% this year, it's going to be really challenging. That's probably, we won't see that until next year. So what has to give before the Fed actually changes their trajectory? What has to give is the employment backdrop. We're starting to see signs of that, the layoffs that we're seeing within technology. But the real significant part is going to come out in areas like residential construction, which we could see upwards of anywhere from 300,000 to 500,000 job losses. Once the Fed sees that.
That is conservative, in my opinion. 300 to 500 job losses. If we keep getting the risk on market, yeah, that's fair. But, I mean, based upon the dry up of real estate industry, I mean, gosh, when I see these companies' backlogs, the way it's drying up, these new home builders, oh, gosh. I mean, I think that's a very conservative number, unless, once again, we go risk on in the overall financial landscape.
That's when they would change course.
Yeah, no, that's completely fair. And at the end of the day, like I mentioned at the top, right? The Fed does not want to see this. They do not want to see us make money right now. That's just the bottom line. And the more money we make, the more they're going to be compelled to keep rates higher for longer and potentially take us up more, because they're going to look at this and like, what are you guys doing? What are you doing here today? You're bidding up all the stocks? Like come on, man, we can't have this right now. Like when inflation's in check, you guys can have your fun, okay? You can make a lot of money, but not right now. The Fed does not want anybody making any money right now. And so, you get this, and the Fed just has to look at that and be like, do we need to go heavier? Do we need to raise interest rates even more to tear down this market? Like, come on, guys, now's not the time yet, right? Next video up here, inflation has moved from goods to services. Now, something very important that Mohamed was talking about yesterday was he believed the Fed needs to go to 50 basis points and should go to 50 basis points. Let's hear if he stays in kind of that realm on CNBC, because the other interview was from Bloomberg.
First time that we've had you on in 2023?
It is. I took some weeks off, and it's really good. And I don't know what has happened. Joe sounds like a globalist. You take him to Davos, and he comes back like a total globalist.
I'm feeling global after being there. No kidding. And you're feeling like a Bengals fan.
I am. Impressive performance, Joe. Congratulations.
Thank you. It was. Don't congratulate me. It's going to take me a while to start believing again after all the wounds, 30 years of 40.
That's
Mohamed,
2 years in a row, Joe. I mean, you got to start believing.
Burrow is making me a believer. I hope he doesn't wear one of those crazy outfits before next week's game.
Well, you become a globalist. I can't get over this. You a globalist. I just can't.
No, did you watch last week? I did. I even said I started to miss. It'll be a better world if China reopens, Mohamed. I can't believe I'm saying that. And we need. They're not going to be us. We're not going to be them. We can't expect to get that they're going to just be perfect, or any other country is going to be perfect. And we just need. Right. That's how I became a globalist.
What did they give you to drink there, Joe?
Kool-Aid, obviously.
Yeah.
Hey, Mohamed, let's talk about what's happening this year. So far, the year is young, 23 days in, but you are talking about some pretty phenomenal rallies that you've seen in stocks and bonds to this point. You think that trend continues?
You are for three reasons, and you heard it. One is economic prospects have improved. Two is the market feels inflation is mostly behind us, the problem. And three, the Fed has signaled that it's going to downshift to 25 basis points. And not only have we done well domestically, we've done even better internationally with two big trades from the U.S. to the rest of the world and into bonds. I look forward and I see many potential outcomes for this year. The one that Joe cited a few minutes ago is certainly a possibility, not a probability, but there's also others. So I think the year we're going to romance different outcomes with respect to growth, inflation, and the Fed.
Okay. Larry Summers was a little more sanguine about the environment, what the Fed's going to have to do. But he did make the point last week that the one thing we have to make certain is that inflation is really dead and it doesn't come back to haunt us, so that we don't have to fight this fight twice. I would assume you're kind of in the same camp on that.
I am. And the inflation dynamics themselves are not very encouraging, because what has happened is inflation has moved from the goods sector to the services sector. And that's much harder to contain. So I'm in the very, very small camp who thinks that they should not downshift to 25 basis points. They should do 50.
The way to kind of think, well, let's finish this off and then I'll talk.
They should take advantage of this growth window we're in. They should take advantage of where the market is, and they should try to tighten financial conditions, because I do think that we still have an inflation issue.
So the way to kind of think about that, folks, is when he's talking about go from the goods sector to the services sector, think about it in terms of like buying something off Amazon is more of like, you know, the goods sector, and services sector being something more like going to the restaurant or something like that, which, by the way, I don't know if you guys have gone to the restaurants lately. Man, prices have gone up a lot over the past year. I'm like, holy smokes, this is no jokas. But nonetheless, he's talking about it's harder and stickier to get it out of services, which is a fair point in regards to that. So we'll see what the Fed's next move is. But I can just tell you, they do not like what's going on. The bottom line is we still got CPI that's in the sixes right now. Sixes. And the Fed wants to get it to the twos. And seeing the markets going risk on like this, and seeing financial conditions that's called ease and loosen, they don't want to see this. So now the Fed's we'll see what happens, but it seems like they're going to have to come out even harsher than previously thought, which is interesting. And we'll have to just see how all this transpires. So hope you guys enjoyed today's video. As always, thank you everybody that subscribed to the channel. 22,000, and oh gosh, we might be at 22,200 subscribers, which means somebody's going to be 22,222 subscriber, which is like the best number ever. So appreciate everybody supporting on Patreon. Make sure you check that out. It is man, there's nowhere better you're going to join than that place. Let's put it that way. Except my private stock group. That's way better. But anyways, I digress. Peace. Much love.